Okay, so finally, I'm going to throw a couple of questions and comments out again. This is my style of kind of interviewing. I just kind of throw all my thoughts out, all my questions onto the table.
Fire away.
You can pick that dead carcass like a crow if you want, whatever you want. Right now with our super, what do? Should we worry? Or do we pay our fund managers to worry for us? Like, what are we doing right now? Because super isn't an asset. I was thinking this yesterday, Brian. Super isn't an asset for retirement, quote unquote. Super is a wealth asset as long as we're living. It's a life asset where we can just start to access it at retirement.
I think there you go. Okay, the way I would think about super is, look, super is the longest term investment any of us are ever going to have, really. Okay, and it's important that how your super is invested should reflect your stage of life, your financial goals, your financial needs, and your appetite for risk. Now, when you go through periods of volatility like this and you say, well, why should I stay invested when I have to put up with this stress every so often? And my answer to that has always been, why would you put up with this level of volatility? You put up with this level of volatility because the reward you get is a better long-term result. In other words, you get rewarded for risk.
Yeah.
And not always, but over the longer term, you get rewarded based on how much risk you're prepared to take. Now, that said, does this mean we should all just pile in and buy equities until they're coming out our ears? The other story I like to tell people is the sleep at night test, is that you need to take as much risk as you're comfortable with to get a higher return, but not so much risk that you're losing sleep at night. And it's almost like, look, if you're losing more than about 2 minutes of sleep at night because of something you're doing with money, whether it's your super, your small business, or your mortgage or whatever, it's like your body telling you something. Your body is telling you you're taking too much risk.
Yeah.
And so there's a trade-off there.
But also, I think that's a good point, but you can actually lean into that. One way to reduce that inherent feeling of risk is education.
Correct, absolutely.
And, plugging my laptop back in. And I think what I'd probably say to people is we probably don't need to look at our super balance every day.
Nope.
Why are we looking at something we can't touch for 20, 30, 40 years?
I think that's a good point.
Check it every 6 months if you want.
Absolutely, and I mean one of the I suppose ironic things is that given the advances in technology and given we have an app, for example, where you can do a lot of things with your superannuation portfolio with ART, and also other providers have a similar app where you can do so much on your phone. Now, that's both good and bad. Maybe it encourages people to actually look too often because they can. It's in their hand. It's in their pocket. Because I often think that when it comes to super, sometimes benign neglect is a good strategy.
Yeah.
If you just ignore it and just have a look at it every few months or have a look at it once a year, because the last thing you want is to be looking at it every minute of the day and potentially panicking about it and responding. It leads potentially for people to make really poor snap judgments and make major financial mistakes like, oh no, the market's down 10%, I'm panicking, I'm selling. And all you've done then is just lock in a loss.
But if the market is down 10%, you open the super fund the next day, your fund won't be down 10% because it's not all in that market.
Correct,
that fell
exactly,
10%.
Yeah.
And I would say for those who are struggling with this, what I want you to do is look at your super fund. It's a unitized fund, right?
Yes.
So someone logs into ART, their account, it says balanced portfolio, growth portfolio. It'll tell them how many units they hold, I think.
Yep. Oh, well, we just put the dollar value.
Yeah.
So you see, this is how much money you've got.
Yeah. And your goal is to buy as many units in that fund as possible.
Yes.
That's the goal.
That's it. It's like the price of these units goes up and down.
Yeah, but just have as many units as possible.
That's right, because and especially during a period like this, and when you look at what professional investors do during a period like this, professional investors are actually not panicking and selling. They generally look for opportunities to buy. When other people are panicking, it's our job to look for opportunities, and that's exactly what we do. And telling members that when people say, "Well, should I be becoming more defensive. It's part of our education challenge, and this is why podcasts like yours are so valuable, is that educating people and telling them, well, look, this is part and parcel of long-term investing. You'll inevitably go through periods of where markets are challenged, where share prices are falling.
And as your employer contributions are going in, they're buying cheaper units
correct,
anyway.
Exactly. And so it means that all your regular contributions are now taking advantage of this market volatility without you having to do a damn thing.
Awesome.
I think that's a really important point.
So what should we do? Probably nothing. Should we worry? Probably not.
I think that's the thing.
Why do we even do this episode today?
Well, hopefully so people don't need to worry so much. Look, if you are losing sleep at night, we would encourage people, firstly, if you have your own financial advisor, get on the blower and have a chat to them. If you don't have a financial advisor, talk to your super fund. And they can provide some limited advice, but they can also refer you to a financial advisor if you need more complicated needs. This is where financial advice is really powerful because it stops people from making really poor investment choices at a really bad time.
It's funny. I was, and we do have to finish, but I was saying to someone the other day, and I think I even said it on a podcast, I'm like, people freak out, particularly, with the Retire Right podcast for the over 55s, to get financial advice. At the moment in Australia, in this climate, it could cost the minimum of $5,000, right? However, the question isn't, well, if I pay $5,000, will I get $10,000 back? No. We're paying that money to an advisor to make sure we don't do something dumb that will cost us $20,000, $30,000, $40,000, $50,000. We're paying for advice so we don't make a strategic mistake that could cost us thousands and thousands of dollars.
I think that's right. I remember speaking to a financial advisor some years ago in Perth who basically said, my job is to hold people's hand. I'm a professional hand holder. I hold people's hand through life so they don't do dumb things with money. And I think that's a really powerful way to think about it.
Well, Brian, we'll have to have you back maybe next quarter.
Delighted.
We'll see what happens between then and now.
Who knows? Who knows what could be happening between now and then? But it's always good value to come on, Glenn. So thanks very much again for your time.
No worries. Thank you to Brian Parker from the Australian Retirement Trust. He's the chief economist. We'll put a link in the show notes to their website if you want to check out their stuff. My name's Glen James. This was Brian. You've been real. See you later. Thanks for listening to today's podcast. If you want to support us, there is one way you can do that. You can send the episode to a friend, a family member, or your group chat if you think those people would find it valuable. We also thank you for leaving a review on Apple or Spotify. If you've listened to this podcast for some time, or if you've read any of my books, you would know that giving and generosity in a financial sense is a big thing in my life. If you think it's time that you are ready to give financially to a good cause, you could head to our website, moneypodcast.com.au/charities to see the charities that we support.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the product disclosure statement, PDS, and target market determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive Pty Ltd, the publisher of this podcast, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds Financial Services Licence 451289. Opinions or comments from any guests on the podcast are theirs and not those of the host or the publisher or their respective licence holders.